Hi, I'm Lena, and welcome to Super Data JP, the channel where we turn Japan's real estate and cost of living numbers into answers you can actually use. Every video here is built on verified government data, not opinions, and not guesses. Whether you're planning to invest, relocate, or just curious what life in Japan really costs, you're in the right place. Let's get into today's numbers.
In Japan, you can owe tens of millions of yen in tax on stock you haven't sold, just for leaving the country. No sale, no cash in hand, just a tax bill triggered by your plane ticket. This is the third video in our series on the tax, visa, and legal traps that actually decide whether a Japan-based investment or career works out. We've covered capital gains when you sell property, and inheritance tax for foreign residents. This time, what happens to your portfolio the day you leave Japan for good? Search Exit Tax Japan, and you'll find two completely different taxes sharing the same nickname. Only one of them is what this video is about. The first is the International Tourist Tax, a flat departure fee, just raised from 1,000 yen to 3,000 yen per departure starting July 1, 2026. For a family of 4 taking 2 trips a year, that's 24,000 yen annually. Annoying, but simple, and not what we're covering today. The real subject of this video has an official name: taxation at the time of moving out of the country. It targets unrealized capital gains on your investment portfolio, triggered by your date of departure. Japan introduced this in 2015, explicitly to close one specific move: build large capital gains while living here, then relocate to a zero-tax country before cashing in. The government's stated logic was straightforward: profits that grew inside Japan's economy should be taxed before they leave with you. Japan isn't alone here. Canada, Australia, Germany, and France all run comparable exit tax systems of their own, each targeting the same kind of pre-departure tax planning. 2 conditions have to both be true before this tax applies to you. First, your relevant financial assets, added together, are worth 100 million yen or more on the day you're checking. What counts toward that number? Listed and unlisted stocks, bonds and investment trusts, unsettled derivatives and margin trades, and silent partnership equity, including holdings outside Japan, and even assets sitting in an unrealized loss. What doesn't count? Real estate and cash in your bank accounts. This tax is specifically about financial assets that could have been sold for a gain. Second condition: you've had a domicile or residence in Japan for more than 5 years within the 10 years immediately before you leave. If you watched our inheritance tax video, you already know Japan sorts every visa into Table 1 and Table 2. That same split decides this 5-year count too, but it runs in the opposite direction. Time spent on a Table 1 visa: highly skilled professional, business manager, engineer/specialist in humanities, intracompany transferee, and similar work-based statuses, does not count toward the 5 years at all. Time spent on a Table 2 visa: permanent resident, spouse or child of a Japanese national, spouse or child of a permanent resident, long-term resident, counts in full. For inheritance tax, Table 1 was the favorable status. For exit tax, the exact same split flips. Table 1 time protects you here. Table 2 time is what starts the clock. The practical result: someone who stays on work visas indefinitely, never switching to permanent residency, can build an enormous stock position over a decade in Japan and still owe 0 exit tax on it. Meet both conditions, and the tax office treats you as if you sold everything the day before you left, taxed at 15.315%. That's 15% national income tax plus a 0.315% reconstruction surtax, the same surtax structure we've covered before. Notice what's missing compared to a normal stock sale: the usual 5% local resident tax doesn't apply here, because by definition you're no longer a Japan resident on January 1st of the following year. Run this against a real scenario: someone who built a stock position over several years working in Japan, then plans to leave. Cost basis from vesting and purchases over the years: 40 million yen. Portfolio value at departure: 130 million yen. That's an unrealized gain of 90 million yen, money never actually received. Taxed at 15.315%, the exit tax bill comes to 13,783,500 yen, about $85,083, due on stock nobody sold. There's one more wrinkle most people miss. Which date decides that the value of your portfolio depends on a completely separate choice. Appoint a tax agent in Japan before you leave, and your portfolio is valued as of your actual departure date. Skip the tax agent, and it's valued 3 months before departure instead, and you have to file and pay by the day you leave, not the following March. In our example, the market moved between those two dates, 120 million yen 3 months out versus 130 million yen at departure. That gap alone changes the tax bill by 1,531,500 yen, about $9,454. Neither date is universally better. If you expect the market to keep climbing, the no-agent path locks in a lower valuation before you actually leave. If you'd rather not sell anything immediately, the tax agent path buys you years of deferral, at the cost of a valuation set after you've already gone. With a tax agent, your return and payment are due March 15th of the following year. Without one, both are due by your actual departure date, in cash, immediately. That second option, deferral, is the main reason most high net worth departures do appoint a tax agent. With a tax agent, collateral equal to the tax owed, and annual asset reports filed every March, you can defer payment for 5 years, extendable to 10. Without being forced to liquidate investments at a bad moment just to cover a tax bill on money you never received. Return to Japan within 5 years still holding the same assets, and you can request the entire exit tax be cancelled. Sell the assets abroad during the deferral period and get taxed again there. Japan allows a foreign tax credit against the exit tax already paid, preventing full double taxation on the exact same gain. This matters most for stock-compensated employees at tech and finance companies, anyone who has built meaningful equity value while working in Japan, and anyone approaching the 5-year mark on a Table 2 visa. If you're anywhere near either threshold, the prep work starts years in advance. Track the cost basis on every position you hold, monitor your total financial assets against the 100 million yen line at least once a year, and know exactly which visa table each year of your residence history falls under before you ever book a departure flight. The headline shock is real, 15.315% on gains you never realized. But which visa table your years fall under, and which valuation date applies, matter just as much as the rate itself. Quick recap of the numbers behind Japan's exit tax. Asset threshold, 100 million yen. Residence test, over 5 of the past 10 years, Table 2 time only. Rate, 15.315%. Deferral, up to 10 years with a tax agent. Check this against our inheritance tax video. The same Table 1/Table 2 visa split shows up there too, just working in the opposite direction. That's the real mechanics behind Japan's exit tax, and the visa and timing details that decide whether it applies to you at all. Subscribe for more data-driven breakdowns of real estate and investing in Japan.
And that's today's breakdown. If you're serious about real estate or moving to Japan, research like this is exactly what separates a smart decision from an expensive mistake. Subscribe so you don't miss the next deep dive, and drop a comment if there's a city or word you want us to cover next. Thanks for watching, and I'll see you in the next one.